5 months ago, I did an interview with Peter Grandich titled Peter Grandich is massively bullish on uranium. And that turned out to be an amazing call. Very excited to welcome Peter back. Welcome, Peter.
Thank you for having me, Elliot. And even a blind squirrel can find the nut after 40 years being in and around this business. So thank you.
No, absolutely though. But you were buying it, when no one else wanted it. The chart looked absolutely terrible and just complete kind of contrarian trade. So I guess kind of my thoughts are, where are you now with it?
Well, you're right. I had not been a person that had been involved in that market in any real way until about 18 months ago, maybe as much as 2 years ago. It got my interest by hearing somebody speak about it, and I didn't realize how depressed that industry and the price had come. There was always a handful of newsletter write-up peoples and so forth that used to be around the junior resource market circuit. I haven't been around it in 8 years. And they would always talk about it, but it had a run many years ago, and then it kind of didn't hear anything about it. And I saw where it was. And then I started to, when I listened to what this person said and I started looking at everything, I said, wait a minute, everybody's talking about we're all going to need all this more power. I mean, we're going to need all these electrical cars. Where's it coming from? There's not enough sales and solar and all that that's going to do that. And I says, maybe this uranium is something to look at. And the more you looked at it, the more it looked to me. And perhaps the single biggest point, Elliot, you picked up right away, and that was no one was interested. There was the handful of people that talked about it for a while, but no one else. And anybody that would be asked about it would give a negative view. And the contrarian in me, and that's really what I've been most of my career, just lit up. I didn't mean that to be a pun, but it ended up being. And so I got it in a big way. And, I was looking at things at Cameco at 8, and some of these stocks were down 90% from their highs, the URAs and things of that nature. And I went in a big way, and I said that I thought before it's over, and it's far from over, but I have to tell you something I did. It's far from over. I said it would be the best bull market that I would ever be involved in my lifetime. And I think it still has a much bigger way to go. But I made a choice to take my profits. Many were up 300, 400, 500%, some of these stocks, because another market presented itself a couple of weeks ago, just like uranium did 18 months ago. There was almost no one bullish. Everybody had thrown in the towel, and things were selling, for pennies on the dollar. And that was the gold and silver market, and particularly mining shares and juniors. So only for that reason did I move out of uranium, and then not because I believe that that market is over. In fact, it's probably only in the second or maybe third inning of a 9-inning game.
So it seems like that's your philosophy, to buy things that are unloved and hated and then go in big. And so that definitely worked out in uranium. And now you're saying you're shifting to gold and silver. Is that because you see very poor sentiment there?
Yeah. So, after making and losing millions, not once, but twice during my career, I learned a lot of things, right? And the fact that I was able to survive and prosper eventually was a blessing. But it's not how much you make, but it's how much you don't lose during the downtimes, which is going to separate you from the winners and the losers. And so I view uranium back then as I view gold and silver now. It wasn't that they were going to go skyrocketing higher, but they seem to have very limited downside risk. They got to the point where, especially when compared to the general equity market or things like Bitcoin, which are up, X thousands of thousands, tens of thousands %, it just seemed to me like uranium was then. The gold and silver market had gotten to that. In fact, just a couple of weeks ago when I made this switch, somebody stated, and I may be off a little bit, but I think I'm in the realm, that almost 3/4 of all junior resource stocks were within 10% of their 52-week lows. So it wasn't like I was getting into a roaring bull market. In fact, it is a market historically that has disappointed more people than made them happy to begin with. It seems to always have a much shorter open window than closed window. But the combination of where gold and silver and the shares were, plus where everything else was, it seemed to me that I needed to. And because, and one other important thing, and I'm long-winded here, sorry, but The fact that I want to end the year with a very large cash position overall because of how bearish I am overall on things, the general equity market, bonds, the economy. So rather than use up cash and go into a less cash position, that's the main reason why I used my so-called uranium money into the gold and silver. But if people own uranium right now, there's no reason to exit. It's just that for my personal needs, that's what I needed to do.
That makes a lot of sense. So, right. So you're moving somewhat defensively because you're going into a area that's been completely beaten down already, and like you said, the downside risk is not as high as, say, tech stocks. So why? I mean, I don't know if you've heard this exponential age thesis and how, all these technologies are coming together at once, and it's going to be the greatest growth of our lifetime in tech and crypto and everything. You're not convinced by that big growth story at all, are you?
Well, I've been called a lot of names lately. Well, I've always been called names. There was always a segment. They usually do it through the safety of a keyboard and the anonymity of a chat room. But because I had taken a stance most recently against Bitcoin, in fact, I called it the AOL of the 21st century. It brought out a lot of that mindset that you just said. You're an old man, you don't know, things have changed, this, that, and the other. And so John Templeton, who was a phenomenal investor, of course, passed away several years ago, said that the worst 4 words you could ever hear in investing is "it's different this time." And yeah, cultures change and technology and all change, but the premises pretty well stay the same. And people are now making the premises have changed. A lot of the 21 and 22-year-old internet gurus who popped up in the last 18 months or so, who everybody is featuring, their probably last biggest mathematical problem was an algebra class a few years ago in high school. And I've learned experience is the best teacher. And until I'm proven wrong, I don't think we made this total change. It doesn't mean that technology, certainly if you just look where we were 100 years ago, tremendous changes in technologies, but many of the premises still stay the same. And one of them is this: when Wall Street gets behind a product or a thesis in such a huge way, as it has with Bitcoin, it did it with mortgages back in 2007 before that crush. It did the same thing in the internet. History goes back. They did it with railroad stocks 100 and something years ago. Whenever they do, Elliot, the last sentence that's used to describe that whole story is never "the investing public lived happily ever after." They're the ones that are usually ones, in a sense, left holding the bag or didn't see the gains and all that Wall Street and the people in the financial service business did. And that's where I think the Bitcoins and all of the world now, they've done phenomenal. And I'm not against cryptocurrencies. I want people to understand that. I believe, like the internet, there'll be a shakeout. A lot of these coins will disappear and all, but out of that shakeout will come dramatically better companies than even now, and they'll prosper for years to come. The problem is that for Bitcoin, and while I call it the AOL of the 21st century, is their technology and their problems of being first, while useful to them now, will actually become a deterrent. Many of the sharpest minds, and I don't have a sharp mind when it comes to that, but I've been smart enough to look at and figure out who does. And many will tell you privately, not so much publicly yet, but they're starting to come out of the woodwork now that there are better coins, so to speak, in that world than Bitcoin. So when the inevitable bust comes, and I think it's coming fairly soon, and the whales have moved on, and the public is kind of left. I'll give you an example. Earlier this year, when I first spoke against Bitcoin, so to speak, at 65,000, and I said back then I would sell Bitcoin and buy uranium, if you remember, and that turned out to be a much better trade, because Here we are several months later, and the uraniums are up, 200-300%. The price is more than doubled, and Bitcoin made a couple $1,000 more high before now, as we speak, a couple thousand below the 65,000. But in that time frame, so much more of the public has gotten involved with Bitcoin. It is so much more spread, and that's the typical distribution. That's what normally happens at the tops, and the tops of Euphoria, where people just, everybody thinks it can't miss, and you can probably tell because when you post this, the comments and people who are in it will be vast because so many people own it and they don't like hearing something that goes against what they're in. And also, I just say to you that yes, it's very important to be a contrarian. It becomes tough being a contrarian, especially as it was both during that uranium cycle and now the gold cycle, because you can't find support. And the difference is for gold is already normally hated by the financial service business anyway. It flies in the face of financial assets. So you're never going to get widespread enthusiasm for it at any period of time. But even the crowd or people that would normally be a supporter of it kind of threw in the towel, went over and said, Bitcoin's the new gold and all this other stuff. And yet, here was the key, Elliot. The central banks continue to be aggressive buyers of gold. In fact, Russia, China, where I think, are basically enemies of the United States, whether it's declared or not, and who will most likely be one of the first to move away from the dollar as a reserve currency. I think they've been acquiring gold because they know gold is going to have to be part of when all this debt bubble and financial bubble implodes and it gets bad. People aren't just going to accept paper money. They're not yet going to accept Bitcoin either. So you're going to have to put out some type of fiat currency that has some real backing, and that's where you'll see the gold tied into it. So that's kind of one of the many reasons, why I'm so bearish on general equities, bonds, and Bitcoin. And the only real light I see where capital appreciation, as we speak, is still before us is in uranium, but in more of a sense, for me at least, in the gold and silver and even things like copper market and things like that nature.
So yeah, it's right now there's bubble behavior being exhibited in tech stocks and crypto, and a true pure contrarian would not chase that at all, even though it could still melt up a little bit. And there could be, but it could be like trying to catch a falling knife on the opposite direction, right? Because you try to time the top, and that's how you get hurt. That's possible. I'm totally with you on that. And I love how you say the narratives that kind of go with bubbles is it's different this time. And some of those narratives are gold is dead and that the Federal Reserve is going to be able to prop the stock market up forever, pretty much. So I guess to the second one, why do you think that the Federal Reserve is going to run out of options and not be able to prop up the stock market as much as it has, in the past?
When this bubble breaks, and like you said, it could blow up from a much higher point. I'm not saying that 5 minutes after we're done this interview, it all comes apart.
Right.
But when it does, and people look back, and historians, and I'll be long gone, you're a young man, hopefully you'll still be around, and historians look back and describe and point and said, we should have known, look at this, look at that. I think they're going to look at a couple of things, but nothing will stand out more as a signal that we should have heard the bell ringing than when it came out in most recent weeks that members of the Federal Reserve, including the Fed chairman, were buying and selling stocks, were trading their own accounts, were knowingly investing while they were making decisions on things that they are a group that have more single influence on what a market does than anything else. And one of the things I think that cost them, and like you said, to answer your question, why don't Peter think that the Fed will be able to continue to do what they're doing, is the curtain has been pulled away. And like Dorothy saw when she found out that the little wizard was just a little guy pulling bridges, that's what people are finding out now and seeing about the Federal Reserve. And why I suspect, I could be wrong, but, and who knows, by the time you release this, there might even be the news be out. But I think Biden will make a change. I think he will not renominate Powell. I think he'll go with Brainerd. And it'll also give Powell an excuse to step aside with the other guys and start going making $2 million, $3 million speeches and not be there when it all implodes. Certainly, if I was his personal friend, I would tell him, please God, hope you don't get renominated. And this way you could step out. But so that's one of the reasons I don't think the Federal Reserve will have that thinking. The second thinking is that everybody, I shouldn't say everybody, most people believe it can happen. They've gotten used to a belief of that being. And the old saying is nothing goes on forever. So you're almost in a sense, it's kind of like the guy standing at the roulette table and he saw red come up 26 times, says, I better start betting black because it's got, even though sometimes it can go 30 or 35. So I think there's a whole host of reasons economically. I think socially, I think we have seen this wealth separation between the 90% of Americans who are barely keeping their head above ground or falling back to the 1 to 10% that have gone forward, much of it thanks to what's happened in the financial markets. I think that's coming to the forefront. And I think the political problem is this also. This is something I don't think people are taking into account. So when we had the crisis in 2008, and to a lesser extent in 2000, and of course the 87 crash, the political parties had to go in a room and try to work things out, come up with things. I don't think that can happen now. No matter what transpired, barring nuclear war, I don't think both political parties could go in a room now and come to a solution, even though the one back in 2008 wasn't the best. At least it was a solution and it was workable. And I think that's another negative. And that all falls on because everybody had assumed the Fed has assumed all responsibility for everything fiscal and monetary, and it hasn't, nor can it. And so I don't see the Fed as coming riding in on the white horse that it has managed to do over these last few decades.
You're right. I bet if you back test every single time a mania hit this type of level, you just back test it, look at every single other example, it never worked out, ever, right? For the investors who tried to chase it at the top.
Yeah, there's one other thing, if I may, Elliot, which is important in my thesis, and that is lack of experience. And it's not a reflection on youth, but experience is an important thing to have no matter what you're looking at, wherever you're working. About half of all financial advisors now licensed in the US, some of them just work in the back office. They're not people that are given actual advice and all, but over half have only been licensed since the last financial crisis. And only a third have been licensed since before the millennium. And so realistically, at least for half of them, they've learned to drive on a one-way street. They have not seen two-way traffic, let alone come to a traffic circle. Now, I always say this, doesn't matter how old you are, because if you've ever driven, if you remember that first time you came to a traffic circle after you got your license or you were learning to drive, you were petrified because people were coming from all over. And that's what I fear is going to face when the inevitable bust comes. Even if the bust wasn't originally going to be dire, it can accelerate to the downside because of lack of experience. And there's one other part of that equation that no one talks about. I shouldn't say no one, almost no one. I don't hear this conversation almost at all. But over half of the money that's in the US markets now is in passive funds. It's in funds that aren't being actively managed. So you have to consider that money on the side. The only reason that fund acts is in order to keep matching whatever index or whatever it's matched to. And the manager doesn't have to make individual decisions to sell this stock or buy this stock because the economy is doing this or this news on that. It just has to keep with the flows of money. When the inevitable turn comes and people looking to get out versus getting in, you won't have a manager being, oh, go, wait a minute, I shouldn't sell this stock. This is a good stock. He or she won't have that choice. They will just have to sell, and selling will beget selling. It's not something that's spoken about. I don't think even most people realize that fact, but I think it'll be a contributing factor when the inevitable downturn comes.
Absolutely. And it's just a really interesting concept because I'm sure you know many people that are really heavily invested in their 401ks and retirement plans in the stock market. So if they're is a correction, just thinking about the people you know, like what's going to happen to society? Do you have any kind of idea of how it'll look?
Well, the big concern I have, like I'm in a 55 and over community, and still much of the wealth that is in markets is held by people 55 and over. It's just a fact of life at this point in time. Uh, what's interesting, I hear more of this than anything else. Well, Pete or Mr. Grandich, if they didn't really know me, I don't care if the stock goes down 20%. I just hope they don't cut the dividend because I'm living off the dividend. Because one of the things that's happened is the Federal Reserve destroyed the fixed income market. See, years ago, when you turned bearish or whatever, you just moved people into fixed income, and they'd be happy at 4, 5, 6, 7, it used to be 8, 9%. There is none of that. People had to chase much more risk-oriented, principal risk investments in order to maintain a lifestyle. And no one has done that more than the senior community using dividends. And when you talk to some of the people, and I'm not just talking about people where I live, but people that I speak to around the country because of my work that I still do, you hear this same thing across them. Well, I bought these, and do you think they're going to keep paying the dividend? And you try to explain to people that if we have a real strong economic downturn at all, no matter how good the companies look like now, when they start to need to conserve cash, one of the things is they cut the dividend or they omit it. And you tell people that and they go, oh my God, I don't know what I would do if that would happen. So that's another issue that isn't considered or taken into account right now and all, but will be if and when this, downturn comes in. And what I fear most is what might have been considered a normal downturn 20 or 30 years ago because of some of the things we've just discussed. I think it will be accelerated to the downside. And just like buying begets buying, in manias, the opposite happens in sell-offs, and they tend to go down faster than they go up. Doesn't matter what market is. Things just, it's the old story. You take an escalator up, but it's an elevator down, and that's where I'm afraid that we're going to see in the market in 2022 and beyond.
Wow. Yeah. Hey, it makes sense. Everything you said makes so much sense. So it'll be a very interesting time if that happens, even politically, like you said. And wow. And that's why gold is a safe haven asset that people might turn to versus.
Yeah, Elliot. And again, it goes back to the decision on my part was, even if it doesn't go up a lot, I didn't see myself losing 25 or 50% in it. But I could see the markets and some technology and coins and those, the Bitcoins that were losing that. And a lot of people that are in those things, they don't have a safety net. Most of what they have working is in those things. So, it's like a double risk for them. So like I said, it's not how much you make, but it's how much you don't lose, which is going to be important. And it seemed to me that gold and silver and even mining shares, major mining shares in particular, they were kicking off free cash flow for the last couple of years. They never did that for all the years I was involved with them. So even the industry had gotten its act together and all. And so it just made a lot of sense for me, and what makes sense for me doesn't mean it's going to make sense for others that are watching this. But, if you're here asking me, what am I doing and what are the hard lessons I've learned? The ultimate crime in investing is never being wrong. Trust me. I know it doesn't seem like that when you turn on those financial networks, but other people tend to be wrong. And when I was wrong, the real crime is when I stayed wrong and I allowed hubris or pride or whatever get in my way. In fact, I have a book called 7 Deadly Sins of Finance, and that's a lot of the mistakes that I made over the years. I learned from them. But I would just tell people now is this is the answer to, maybe we'll end the conversation like this. This is the question you heard most often in the business. Hey, you guys always tell, and gals, you guys and gals always tell us when to buy. You never tell us when to sell. And it took what happened to me in my first half of my career, or almost 20 years, to come to this answer in my second half. Well, if you couldn't first buy whatever it is today at today's price, forgetting what you were in it, whatever you're up or down, and put that money in it today, if you hesitate or even say no, then that's your answer on whether you should sell or not. And it's surprising how many people will go, Yeah, I couldn't, but you know what? Then they make the classic mistake. And I'll close with this, Elliot. Hope is a wonderful spiritual strategy. It's important to have. I would think if you didn't have hope, it'd be hard to live, whether you're a believer in God or not, just to have hope that there'll be another day or what have you. But it's the worst investment strategy in the world. I only hope this stock goes back. I only hope this market goes up or down. When you're at that level, when that is what's leading your investment decisions, you're asking for trouble.
Wise words. Thank you so much. You totally summarized your thoughts on today's market, and you're always doing something interesting. So if you wouldn't mind letting us know where we can go to find you and learn more about you and stay on top of your updates.
So, Elliot, at this point in time, I just tell people to go to Twitter because that's where I spend most of my time sharing. We have a blog on my website. The only livelihood other than handling my own personal investments, I am part of an alternative traditional financial planning group here in New Jersey, where we specialize in teaching people how to use cash flow. We believe cash flow is the key to success, not chasing net worth, but they have to be U.S. residents for us to even consider being able to use them. So I would say Twitter is the best place.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.